We know that most economies use markets to answer the question of who will get what is produced. But markets directly answer this question with prices. Up to this point, we've learned that under the most common specifications used to model a commodity market, the quantity of goods and services supplied and demanded is determined by the price in the market. And naturally, you may be asking, what determines price? The price in our simple supply and demand model of a perfectly competitive commodity market is actually determined by the evidence of a surplus or shortage of the good or service. If there is a surplus or an excess amount of goods or services left in the market after all willing buyers are satisfied, then the price is above equilibrium. If there is a shortage, or if more customers are willing to purchase a good or service after it has been depleted, then the price is below equilibrium. The equilibrium price is the price point at which all goods or service capacity is depleted and all buyers willing to purchase at that price point are satisfied. On the supply and demand schedules, it's the price point at which the number of goods or services supplied equals the number of goods or services demanded. That also describes the equilibrium quantity, which can be found at the equilibrium price point or wherever the quantity and demand and supply schedules equal each other for the same price. On the graphical representations of the supply and demand schedules, their supply and demand curves, this is the point at which both the supply curve and the demand curve intersect each other. You can see that the values on the x and y axis, the quantity and price respectively, for both curves is the same at this point. On the other hand, points where the y-axis values are the same, but the x-axis values are different, represent moments of shortages or surpluses. Where the y-axis value is above the equilibrium price point represents a price point that would lead to a surplus, too much supply and not enough demand. The reverse, a y-axis value below the equilibrium price point, would represent a shortage, too much demand and not enough supply. You can also identify shortages and surpluses using the x-axis. If the supply curve intersects the price point to the right of the demand line, in other words, if the x-axis value for the supply curve is larger than the x-axis value for the demand curve, then there is a surplus of the good or service in the market. The opposite, with the x-axis value for the supply curve being smaller than the value for the demand curve at the price point, would represent a shortage of the good or service in the market. These are truly points at which the laws of supply and demand lead to imbalances. Equilibrium is where the two laws end with a balanced market. The shifting of either of these curves, though, could change where the equilibrium price and quantity lies. And to complicate matters further, those shifts can happen simultaneously at the same time, making it challenging to predict the new equilibrium. This table may help, although we won't be spending as much time on this particular exercise. I just want you to appreciate that fundamental changes to the structure of the market, like how many participants are in it, or how much of a good or service they're willing to sell or purchase at any price point, will change the equilibrium price and quantity prevailing in the market. This is one of the few cases where a change in quantity, albeit across the entire curve, does cause a change in the price, at least to the extent that the shift in the curves causes an imbalance in the market that should be corrected naturally through a change in price.